Welcome to Striking Options, the show that reveals the options you have to better navigate markets. I'm Jeff Kilberg, and I'm joined today by Scott Bauer. Hey there, Scott.
Jeff, how you doing?
I'm doing well. It's a new quarter. Here we go, Q4 of 2019. But we did have some interesting data come out today. ISM number, 47.8, the lowest since June of 2009. That showed a little weakness in the market today.
Yeah, certainly not the way you want to start the quarter off with a number like that. However, October usually is pretty volatile, and, everyone's crystal ball may be a little bit different here.
Well, it's interesting. Yes, October definitely has that stigmatism. We saw the 1929 Great Depression. We also saw the flash of 1987 when we really moved lower. But is October, by and large, is this going to be the month where we see more volatility just like 2018?
I think we see the same as what we've seen throughout the rest of the year here. I don't think we're going to see excessive volatility, but I also think it's going to stay just in the area we're at. We have big earnings season coming up right now, which could lead the market one direction or the other into the rest of the quarter.
All right, great point. It sounds like we have to buckle our chin strap regardless.
Right. Absolutely.
All right, let's get into this first lightning round. Are you ready?
All right.
Gold drop. Well, we did see a plunge in gold yesterday, but what was the reason for that initial gold drop? About $30 drop.
Yeah, you saw the market here, you saw the stronger dollar, and that's really what I was focusing on. And, to me, that really looks like it could be a buying opportunity.
Well, when you talk about buying opportunity, what type of trade example would you embrace? Because we did see it fall from $1,500 all the way down to $1,470, but it seems like that $1,500 level has been quite the magnet.
It really has been. So I'm looking at buying the October week 2 $1,500, $1,530 call spread. And buying this call spread costs an investor about $600 or so, and this expires on Friday, October 11th.
Well, this makes sense. Gives you a little bit of time going out to October 11th. The December futures in the underlying futures contract was trading about $14.86, but that at-the-money volatility only at about 15%. Not too expensive a premium to purchase.
No, we've definitely seen it higher in the last few months or so.
All right, I like that, Scott. And please remember, these are trade examples, not trade recommendations. Let's move into the second lightning round.
All right.
Risk on. Well, after the ISM number, not necessarily sure, but it is interesting to see Q4. If we do see some type of trade tariff conversation, will we continue to see risk on and people put money into the market?
Yeah, I think that's really what you have to look at. And obviously the focus right now over the next week or so is what's going to happen with those tariff talks. And that ISM number really gives an investor an opportunity to potentially get into the market here at a lower level.
Well, that's the trade example I'm exactly looking at. 29.50 is a level that I'm comfortable owning the market. So I want to be a seller of the week 3. I'm going out an extra week here, Scott, giving this trade example a little more time. But I want to be a seller of the week 3, 29.50, 2,900 put spread in the E-mini S&P 500, expiring again October 18th, going one more week out.
Great, and this spread will collect about 12.5 ticks, so the spread allows a trader to collect $628, and the December futures are the underlying here, and they're trading around 29.67.5 with at-the-money volatility about 15.46.
And we talk about understanding why to sell a put spread, why to buy a put spread. In this example, we're seeing premium a little bit elevated today, so we're taking advantage of selling that premium, that 29.50. It's not at the money, but it is closer because I'm comfortable with owning that 29.50, Scott.
Right, and that elevated premium, like you says, lets an investor collect more money up front.
Now, if you want to utilize the micro E-mini S&P 500s, maybe 29.50 is where you have a limit order to capture some type of movement overnight. As you do know, Scott, the micro E-mini futures contracts are open about 23.5 hours a day.
And that's a real great tool for investors to go to.
All right, Scott. Well, thanks as always for coming on to Striking Options, and please tune in every week as we will continue to strike options.